It's some time since we have done the financial budgeting video. This video is a continuation to that video to give you some tips on how to enjoy your financial journey. Many often, being rich is seen as a proxy to being happy. And so achieving good financial returns and making money is seen as the epitome of happiness. But is that the only criteria to be happy in your financial journey? We have seen many people who get anxious about their finances and investments. They do a lot to achieve their plans, chasing up after multiple products, multiple markets, and multiple money-making ventures. But many often, that uneasiness becomes never-ending. On the other extreme, we see some other people who probably appears much calm and achieves their financial targets without much ado. It's not that they do something entirely different, but they have a method to the madness, so as to say. Very often, some of these instances makes us think why it's easy for them. But there are certain efforts that they made in the right direction that rewarded them. It's not that they don't make mistakes, but it's all contained within limits. This video series aims to give you some tips and tricks on how to enjoy your financial journey and to enable you not to lose your life's purpose amidst the financial race. First, let's try to understand our approach to financial products and markets. Understanding where we stand is essential to plan the journey. Normally, we fall under one of the following zones in our approach. The first type is called old guard. These people only try the traditional over-the-counter products, such as the ones available through banks, post offices, etc. They don't want to take any risk. They want complete safety, and they don't want to spend much learning effort in learning new things. So essentially, they stay away from the unknown and choose the comfort zone. Now, the decision tools these people use involve word of mouth, approaching the local brick and mortar contact points, agents, etc. Now, these people, they don't act very frequently on their money. They act as per the maturity date or whenever money comes in. Now, what is the danger with this approach of investment? Their capital often gets eaten away by inflation. And regarding happiness levels, these people won't be really happy because others are making good money and I am not. That will be the mindset that they will have. And they will also have concerns regarding the rate of interest available on deposits from banks going down, etc. Now, the second category of people we have here is called speculator. Now, these people, they want multiplier gain as made by others, but stays away from significant learning effort, but wants to copy attractive markets and products and strategies. The decision tools used by these people involve news, friends who are traders or investors, reports from brokers, etc. Now, their frequency of action will be very frequent as per the inputs that they get, and many a times they panic whenever there is a crash in the market. Now, the dangers here involve very often they lose track of some bits of input info which will expose their portfolio to danger. The happiness levels of these investors, normally they will be a confused mixture of happiness and sadness because they are dependent in decision making on others. The third category is called trader. Now, these guys are rules driven and they will approach the market with a set of rules. They have very low tolerance for losses and they want to time markets to their best accuracy. And they are willing to learn to code these rules. Now, what are the decision tools they use? They use technical analysis, so-called candlestick pattern analysis, Dow theory pattern analysis, etc. They also analyze where the smart money moves, that is the money from institutional investors which flows into the market. And they also make use of algorithmic trading, which is again based on rules and automating it using technology. The frequency of action for them is actually frequent and it will be a rule-based action which will be mainly driven by technology. Now, what are the dangers in this approach? Very often, they miss on the big sustainable movements of the product that they are watching. And mainly this will be due to the frequent rule-based action that they do. So they might miss the holistic picture and the holistic big movements of that particular product. Now, happiness levels per se, traders will be semi-happy, but frequent actions or monitoring takes off the joy from this investment journey process, and managing rules often could become hectic for them and it could become too technical. The next category is called investor. Now, investors look for real value enablers in their product and they aim for a longer time period. They learn the specific product or entity or the market features in good detail and develop foundational understanding. Now, the decision tools used by them involve fundamental analysis, looking at the management credibility and history, dividend payout practice of their specific products or companies, the margin of safety analysis, etc. And the frequency of action in this category is actually very less frequent. Normally, actions are initiated based on significant changes in the industry, policy, management, or say product line, or say saturation in that product, etc. Right? It is only the big picture movements. And the dangers often involve the fact that they may lose money on certain instances due to inaction. Now, happiness levels for an investor, it will be mostly happy days for him, but the only times where they will have a tricky time will be when they miss the right entry or exit points, and very often finding the intrinsic value could become tricky for an investor. Now, the last category is expert investor. Now, these guys are investors first and traders second, and they put in significant learning ability. The tools that they use for decision making involve fundamental analysis, technical analysis, smart money, etc. So it is essentially a combination of being an investor plus being a trader, right? But first comes the investor part or the investor hat. Frequency of action is actually less frequent, and these are well planned moves normally because they have hold over the technical analysis side of it and the fundamental analysis side of it. So dangers in this approach to your financial journey involves the rare unexpected events that can happen, as with the market scenarios like COVID, etc. And happiness levels for this category of people, they normally tend to be very happy, as decision is also aided by technical analysis tools that validates the fundamentals once in a while for the investor. So, the first key to finding happiness in our financial journey is to understand our current approach and where we fall in this grid. Once we identify where we are, it's just a matter of spending learning hours to reach the higher knowledge levels and subsequently higher happiness levels. Long-term investing does wonders with compounding. Markets are fearsome for the speculators and old guards as they do not upgrade themselves. Traders understand the market mainly based on historical trends and do gain, but the frequent monitoring and actions required takes away the joy from the real purpose of life. Try and aim to be in the investor space, so either an investor or an expert investor, to find real joy in financial investing and to put our life to its true purpose while our money grows with minimal intervention. How easy is it to become a good investor? I call it a matter of discipline and certain practices. Let's understand some of the best practices or techniques to becoming a good investor in the coming videos in this series.